Imagine checking your bank account on a random Tuesday.
Right.
And you realize you suddenly have an extra $130 million.
Which is, not a bad Tuesday at all.
Not bad at all. But the thing is, it's not because you worked any harder or because you launched some revolutionary new product. It's simply because the people you do business with are living just a little bit longer than some mathematical model predicted they would, a decade ago.
Yeah, it really does sound like financial magic.
It totally does. But in the notoriously opaque world of life insurance, it's actually a very real, very lucrative mechanism. So welcome, everyone, to a special Talk Tickers edition of The Deep Dive.
Glad to be here.
Usually when we evaluate a company with you guys, we look at tangible things, right? Like the hardware you buy, the software subscriptions you pay for, maybe the foot traffic outside a retail store.
Yeah, those are businesses where the feedback loop is it's immediate.
Yeah.
And highly visible. You look at a quarterly report for, say, a consumer tech company, and you can instantly conceptualize how, a new smartphone launch drove revenue. The correlation is just visceral.
But the financial sector, it operates behind this curtain of extreme complexity. And when you drill down into life and health insurance specifically, that curtain is basically made of lead.
Oh, absolutely.
We are dealing with a landscape dominated by actuarial tables, statutory reserve requirements, risk-adjusted capital. I mean, it is a language engineered to be dense.
Yeah, it really acts as this unintentional gatekeeper.
Right.
The institutional analysts who spend their entire careers modeling these specific companies, they have a massive advantage over the retail investor.
Just because they know the jargon.
Exactly. They simply have the decoder ring for the vocabulary.
Well, today we are handing you that decoder ring. We are cracking open the Q2 2026 earnings call for Globe Life Inc., ticker symbol GL.
This is a fun one.
It really is. The mission today is straightforward. We are going to translate all that Wall Street jargon, look strictly at the hard data they presented to the institutional players, and give you an actionable, opinionated verdict on this stock.
Yeah, we're pulling directly from the raw, unfiltered transcript here.
Yeah, where co-CEOs Frank Svoboda and Matt Darden, along with their CFO Tom Kalmbach, they basically had to answer for the good, the bad, and some surprisingly weird anomalies of the quarter.
There are definitely a few of those.
Yeah, so, okay, let's unpack this, starting with the ultimate truth teller of any earnings report, the top line numbers.
Right, because the raw data provides the necessary anchor before management attempts to, contextualize or in some cases spin the results.
Well, for sure.
And Globe Life's Q2 numbers, they really demand serious attention, especially when you consider the broader economic environment we're operating in right now, mid-2026.
Yeah, so let's lay the foundation for you. For the second quarter of 2026, Globe Life reported a net operating income of $285 million. Right. On a per-share basis, that equates to $3.61. And to put that into perspective, it represents a rock-solid 10% increase year over year.
Which is huge.
It is. But the actual bottom-line net income was even higher. That came in at $288 million, or $3.65 a share, which is a massive 20% jump from the same quarter last year.
Yeah, and I want to pause on that because hitting double-digit growth metrics in a mature, heavily regulated industry, it's not a trivial accomplishment.
No, not at all.
We're looking at a sector where a 3 or 4% growth rate is often celebrated as a major victory.
People pop champagne for 4%.
Exactly. So a 10% jump in operating earnings per share, it signifies a business that is doing much more than just treading water against inflation.
Yeah. But the metric that genuinely caught my eye, it involves their intrinsic value. They reported their book value per share, and they made a point to specify this, is excluding something called AOCI. That's up 11% to $100.04.
Breaking that $100 threshold.
Yeah, breaking the $100 threshold on book value feels like this psychological milestone. But let me take a stab at translating this excluding AOCI caveat, because I know this is where a lot of novice investors just get completely lost in the weeds.
It is a notorious stumbling block.
Right. So AOCI stands for Accumulated Other Comprehensive Income. And in the insurance world, this mostly represents the unrealized gains or losses on the company's massive bond portfolio.
Yeah, that's the mechanical definition. You have to remember the function of an insurance company.
Right.
They collect your monthly premium and they invest it so that the money grows over decades. That ensures they can pay out a death benefit 20, 30, or 40 years down the line.
They aren't day trading.
No, they cannot put that money into speculative tech stocks. Regulators require them to invest primarily in highly secure, long-dated corporate and municipal bonds.
And this is where the math creates a bizarre optical illusion on the balance sheet. Because when interest rates in the broader economy rise, like we've seen, the paper value of older bonds, which have lower interest rates attached to them, that value automatically goes down.
Right. It's just a mechanical rule of the bond market.
So if you include AOCI in the book value, it looks like Globe Life lost a fortune because their old bonds lost, quote unquote, paper value, but management excludes it because it's functionally irrelevant. Like you said, they don't day trade these bonds, they hold them to maturity.
And the distinction between a realized loss and a paper loss is everything here.
Everything.
By holding the bond to maturity, Globe Life will receive the full face value of that bond when it expires, plus all the interest along the way. So the daily fluctuation of its price on the secondary market, it doesn't impact their cash flow or their ability to pay claims in the slightest.
It's basically like owning a house that you plan to live in for the next 30 years.
That's a great way to look at it.
Right. If a recession hits tomorrow and Zillow says your house value dropped by 20%, you didn't actually lose any money unless you panic and sell the house that afternoon.
Exactly.
If you just keep living there, that temporary dip in the Zillow estimate has zero impact on your daily life. So management is excluding AOCI to show us the true operational net worth of the house, ignoring the temporary Zillow estimate.
Yeah, and stripping away the noise of those temporary paper fluctuations, it reveals the underlying efficiency of the operation.
Yeah.
And the transcript points to an incredibly powerful engine driving this company.
Yeah, let's talk about that ROE.
Right, a return on equity, or ROE, of 18.4% on a JAP reported basis.
So an 18.4% return on equity. That means for every dollar of shareholder equity sitting on the balance sheet, Globe Life is generating over 18 cents of pure profit in a single year.
Which is phenomenal.
It is. Now, in the flashy world of software as a service, maybe that doesn't sound earth-shattering, but in the world of life insurance, that number is staggering.
It is exceptionally high for this specific industry. Most legacy life insurance carriers consider an ROE of 10 to 12% to be a highly successful year.
Right.
So hitting 18.4% demonstrates that Globe Life is wringing maximum efficiency out of their capital. They are pricing their risk better, they are keeping their administrative overhead lower, and they're deploying their capital more effectively than the vast majority of their peers.
You know, whenever I look at these legacy financial stocks, the analogy that always comes to mind is the difference between buying a Ferrari and buying a heavy-duty F-350 pickup truck.
I love that.
Right. A hyper-growth tech stock is the Ferrari. It looks amazing, it accelerates incredibly fast, but the moment you hit a pothole in the broader economy, the suspension shatters and you are stuck on the side of the road.
Yeah, total.
Globe Life is the F-350. It's not winning any design awards, it's not turning heads on Wall Street, but it possesses an immense amount of financial torque. It just pulls a massive load quarter after quarter, regardless of whether it's raining or shining in the macroeconomic environment.
And that F-350 comparison holds up perfectly when you look at their risk profile, too.
Yes, so.
Well, you might assume an 18.4% ROE requires taking on risky high-yield investments to juice the returns. But CFO Tom Kalmbach explicitly noted on the call that their exposure to below investment-grade bonds is near historical lows.
Oh, wow. Really?
Yeah, it's sitting at just 2.7% of their portfolio. So they are generating premium returns while taking on exceptionally conservative risk.
I mean, high returns with low risk is the holy grail of investing. But, you know, a headline number is merely a snapshot of where the company stood on the last day of June.
True.
It tells us the destination, but it doesn't really explain the journey. If we want to know if this 10% earnings growth and this massive ROE are sustainable for the second half of 2026, we have to look under the hood.
We definitely do.
We need to identify the specific cylinders that are firing perfectly, and more importantly, we need to locate any oil leaks.
Right. And looking into the operational drivers, the core life insurance business is demonstrating incredible stability. The life underwriting margin is sitting strong at 42%.
Okay, let me just break down underwriting margin for anyone who's new to the insurance space. This is basically their gross profit margin on the sheer act of insuring human lives.
Exactly.
You take the total premium dollars collected from policyholders, you subtract the actual death benefits paid out, and then you subtract the direct costs of acquiring those policies, like agent commissions. Keeping 42 cents on every dollar as pure underwriting underwriting margin means their actuaries are doing a phenomenal job predicting risk.
They really are.
They aren't just slashing prices to steal market share. They are writing highly profitable, sustainable business.
Yeah, the life division is the steady heartbeat of the company. However, the true outlier this quarter, the division that generated the most explosive growth, was United American.
Yes, the health wing.
Exactly. This is their health insurance wing. And they reported that health premiums in this specific division surged by 29% year over year, reaching $211 million for the quarter.
Which is wild. A 29% increase in premium revenue for a legacy insurance division is almost unheard of without some major acquisition.
It really is.
Like, consumers don't just wake up one morning 29% more eager to buy generic health insurance. There has to be a structural catalyst driving that kind of volume.
And the catalyst is demographics. It is a macroeconomic phenomenon commonly referred to as the silver tsunami.
The silver tsunami, yeah.
The baby boomer generation is currently aging into retirement at an unprecedented rate. Every single day in the United States, roughly 10,000 to 12,000 people turn 65 years old.
Wow, 10,000 a day. And turning 65 is the magic number, right? Because that is the exact moment you become eligible for Medicare.
Right.
But here is the catch that drives Globe Life's business traditional Medicare is not a free, all-inclusive pass to healthcare.
Not at all.
Medicare Part A covers hospital stays, and Part B covers doctor visits. But there are significant gaps in there. There are massive deductibles, and typically a 20% coinsurance requirement that has absolutely no annual out-of-pocket maximum.
Which is terrifying.
It is, because if you get a catastrophic illness, that 20% can easily bankrupt a retiree.
And that creates an instant urgent need for supplementary coverage. These millions of new 65-year-olds immediately seek out Medicare Supplement plans, widely known as Medigap policies, to cover those exact financial liabilities.
Yep.
And United American is heavily strategically positioned right in the Medicare Supplement market.
So they aren't trying to invent a new market demand. They're simply standing at the bottom of a demographic funnel that the calendar just fills for them automatically every single day. And co-CEO Matt Darden made a point to highlight this on the call. This is not a temporary spike driven by some clever marketing campaign. This is a multi-year demographic tailwind. The volume of people turning 65 is going to remain elevated for years, providing this predictable, expanding customer base.
The United American growth is a textbook example of being in the right place at the right time with the right product.
For sure.
But as you know, an earnings call transcript is rarely a perfectly clean document.
Oh, never.
Institutional analysts are paid to find the fractures, and management had to answer for some decidedly messy metrics this quarter.
Yeah, the bad news is where the real analysis begins, honestly. So let's look at the two glaring red flags in this report. First, in their direct-to-consumer division, which they label as DTC net life sales, dropped by a severe 15% compared to the same quarter last year.
That's a big drop.
Massive. Second, their quote-unquote health obligations saw a really concerning spike.
Right. And health obligations represent the actual cash paid out to cover medical claims. The transcript shows their health obligations as a percentage of premium spiked to 56.8%, up from 53.3% a year ago.
Ouch.
Yeah, a 3.5% jump in your loss ratio over a 12-month period. That is a substantial blow to the profit margin of that specific division.
Yeah, when you see a spike like that, the immediate fear is systemic failure. Like, are policyholders suddenly 3.5% sicker than they were last year? Did the actuaries just fundamentally misprice the risk?
Which is the ultimate fear.
Exactly. Now, management, of course, deployed a heavy layer of corporate jargon to explain this away as a temporary, isolated blip. So let's dissect their defense, starting with that health obligation spike. They pointed the finger at three distinct culprits, the first being a retroactive change by CMS.
Right. So CMS is the Centers for Medicare and Medicaid Services. They are the federal agency that dictates how much doctors and hospitals actually get paid for specific procedures under the Medicare system.
Right. They set the rates.
Exactly. And management explained that CMS made an industry-wide correction to physician reimbursement rates that applied retroactively.
So the government essentially audited the books, decided doctors needed to be paid slightly more for procedures that already happened in the past, and then handed the bill to the supplementary insurance companies to true up the difference.
Functionally, yes. It forces the insurer to record a localized spike in claims related to prior periods during the current quarter.
I see.
From an analytical perspective, this is an administrative shock to the accounting system. It does not indicate that the underlying pool of policyholders is deteriorating in health.
Okay, I can accept a government reimbursement true-up as a one-off accounting anomaly. That makes sense. But their second excuse involved a startup wing they acquired called Every.
Right, Every. They operate in the group health insurance space, selling plans to businesses. And because it is a relatively new and small division, the total number of insured individuals in their pool is tiny compared to Globe Life's legacy divisions.
And in insurance, stability comes from the law of large numbers.
Exactly.
Right? Like if you insure 10 million people, a few $1 million hospital bills are easily absorbed by the premiums of the 9,999,000 people who only got, a generic prescription that year. The variance is smoothed out.
But if you only insure 10,000 people and 3 of them require $1 million organ transplants in the exact same quarter, it completely destroys the margin for that specific pool.
Yeah, the math just breaks.
Management referred to this as an adverse fluctuation in high-severity claims.
Which is an incredibly polite corporate way of saying a few people in our startup division got catastrophically sick all at once and we didn't have a big enough premium pool to hide the financial impact.
That's essentially it. It highlights the volatility of incubating a startup within a larger corporate structure. A small cluster of severe claims creates a massive percentage swing. However, management views this as a growing pain of a small division lacking scale, not a fundamental defect in how they assess risk globally.
Right, that makes sense. Now, the third excuse for the health claim spike was remarkably similar to the Every situation. They noted an unusual cluster of cancer claims specifically localized within their Liberty National Division.
Yeah.
And whenever an insurance company says, we had an unexpected spike in cancer claims, it sets off alarm bells. Like, are morbidity rates rising nationally? Are environmental factors changing?
It's a scary thought. And during the Q&A portion of the earnings call, an analyst pressed them hard on this exact fear, asking if this cancer spike represented a broader, terrifying macroeconomic trend.
And what did they say?
Well, management's response provided a really crucial piece of context. They pointed to a completely different division, Family Heritage, which actually holds an even larger book of cancer insurance business.
Oh, interesting.
Yeah, and Family Heritage saw very favorable, highly consistent results during the exact same time period.
Okay, that isolated data point kind of saves the narrative, because if national cancer rates were truly spiking, Family Heritage would have been hit even harder.
Precisely.
Because they weren't, the actuarial team can mathematically write off the Liberty National spike as sheer statistical variance. Sometimes, you just flip a coin and get tails 10 times in a row. It's bad luck, not a rigged coin.
Yeah, so the combination of a CMS true-up, a startup lacking scale, and a statistical anomaly in one division, it provides a highly plausible, multifaceted explanation for that 3.5% jump in health obligations.
Yeah, solid defense.
None of these factors suggest a permanent impairment of their underwriting models.
I agree. The health claims defense holds water. But the other messy metric, that 15% drop in direct-to-consumer life sales, that is a completely different story. And frankly, it is the most fascinating part of this entire earnings call.
Oh, without a doubt.
Because management didn't blame inflation, they didn't blame consumer spending habits, and they didn't blame a new competitor. They explicitly blamed artificial intelligence.
Yeah. Matt Darden offered a surprisingly candid assessment of the digital landscape here. He explained that the very nature of how consumers seek out information online is fundamentally fracturing.
Fracturing how?
Well, the integration of generative AI consumers using ChatGPT or Google, prioritizing its new AI overviews over traditional blue links, it has resulted in a precipitous drop in traditional paid search volume.
Hold on. This requires a massive pause. If management is openly stating that AI is permanently altering consumer search habits, causing their Google click volume to plummet, and subsequently driving their customer acquisition costs through the roof, I mean, how is this not an existential crisis for their digital pipeline?
It sounds like one.
Right. If they can no longer efficiently buy search traffic, doesn't their entire direct-to-consumer model just collapse?
That is the exact fear that could drive short-term volatility in the stock if the market misinterprets the data. The cost of a digital lead is absolutely rising. There's no denying that. But we have to look at the mechanical differences in how Globe Life processes a lead versus, say, a traditional e-commerce company. They are not selling a $20 t-shirt where a consumer clicks an ad, adds to cart, and checks out in 60 seconds.
Right. Life insurance is a complex, high-friction product. People rarely buy a 30-year financial commitment without having a conversation.
And that conversation is Globe Life's structural moat. While the overall volume of cheap paid search is evaporating, making every individual digital lead significantly more expensive, Globe Life doesn't just leave those leads in a digital inbox hoping the consumer will eventually click buy.
Right, they have agents.
Exactly. Those direct-to-consumer leads, no matter how expensive they are to acquire now, are immediately routed to their vast network of live human agents.
It's like owning a store in a massive shopping mall.
Okay, I'm tracking.
For years, you paid a cheap rent to have your store right at the main entrance, and thousands of people walked by every single day. Suddenly, the mall owner, Google in this case, completely redesigns the building using AI.
The entrance moves.
The main entrance is just gone. Foot traffic drops 80%, and the rent for a tiny side door just quadrupled. A purely digital company just goes bankrupt in that scenario.
But Globe Life survives because of their human infrastructure. When you route a high-intent, expensive digital lead to a trained human agent, the conversion rate skyrockets compared to a purely passive online transaction.
Because the agent can actually talk to them.
Exactly. An agent can answer complex questions, alleviate fears, and custom tailor a policy in a way a website simply cannot.
So they're essentially accepting that the digital toll booth is going to cost way more and fewer cars are going to pass through it. But they are deploying their human agents to ensure that nearly every single car that does make it through that toll booth is converted into a paying policyholder.
Right. They are mitigating the loss of raw volume by drastically optimizing their final conversion margin.
Yeah, and Darden framed this transition by comparing it to the historical shift from direct mail marketing to digital marketing 2 decades ago.
Which was also chaotic.
Super chaotic. It's a painful transition period requiring entirely new infrastructure. They are already overhauling how they structure their digital content to ensure it is easily parsed by large language models.
So they want to be the AI's answer.
Exactly. They are positioning themselves to be the recommended answer when a consumer asks an AI assistant for life insurance options, rather than relying solely on traditional keyword bidding.
It is a profound look into the plumbing of the internet, really. We talk so much about AI writing code or generating images, but this earnings call shows AI actively disrupting the foundational mechanics of customer acquisition costs.
Yes, in real time.
And if AI is blowing a hole in their digital marketing and health claims just suffered a 3.5% loss ratio spike, the logical assumption is that management is about to batten down the hatches and lower expectations for the rest of the year.
That's what you would think.
But they did the exact opposite.
Right. The guidance portion of this call is what signals ultimate confidence. Despite the 15% drop in DTC sales and the Q2 health obligation blip, management actually raised their full-year 2026 net operating earnings per share guidance.
Which is a bold move.
They raised the range to $15.55 to $15.95 per share. At the midpoint, that represents an 8.5% growth rate for the year.
Wow.
So how do you possibly project accelerating profits when your digital pipeline is fracturing and your health claims are volatile? There has to be a massive catalyst hiding in the balance sheet.
And the catalyst is buried in actuarial jargon, of course.
Naturally.
In the third quarter, Globe Life is scheduled to execute massive assumption updates. Management explicitly guided that these updates will generate a remeasurement gain of somewhere between $110 million to $130 million.
Over $100 million in pure gain, seemingly appearing out of thin air. This is what we talked about at the top of the show. Let's break down the mechanics of an assumption update, because this is the true magic trick of the life insurance industry.
It really is.
Yeah.
The entire business model of life insurance relies on predicting mortality. Globe Life's actuaries build complex, long-term mathematical models based on vast amounts of historical data.
Right.
If they write policies for 100,000 people today, their models project exactly how many of those individuals will pass away in year 1, year 10, and year 40.
Morbid, but necessary.
Very necessary. And based on those precise projections, state regulators require the company to hold a massive pool of cash in statutory reserves. This cash must sit untouched to guarantee they can cover those future death benefits.
So if the math says you will owe $50 million in payouts next decade, regulators force you to lock up that $50 million today.
Exactly.
You cannot use it to pay dividends, you cannot use it to buy back stock, and you cannot use it to fund operations. It's just dead capital sitting there.
But the real-world data is diverging from those old mathematical models. Globe Life is experiencing what they call favorable mortality trends.
Which means?
Simply put, their policyholders are living significantly longer than the actuaries predicted they would 10 or 15 years ago.
The people they insure are healthier. The mortality curve shifted to the right.
And when the real-world data proves the old models wrong in a positive way, the company is allowed to officially update their assumptions to match current reality.
Oh, okay.
The moment those new assumptions are plugged into the regulatory formulas in Q3, the math fundamentally changes. Because the policyholders are living longer, the payouts are delayed further into the future. Therefore, the present-day requirement for that cash reserve drastically shrinks.
So the company looks at the regulator and says, hey, our people aren't dying as fast as we thought. We don't need to hold $50 million in reserve anymore. We only need to hold $40 million. And the regulator just agrees.
The regulator agrees, based on the new math. And that $10 million difference is instantly unlocked. It transitions from a restrictive statutory liability into a remeasurement gain that flows straight into their operating margins. Multiply that dynamic across their massive portfolio of policies, and that simple update to the mortality tables frees up $110 million to $130 million in pure deployable capital.
Which begs the billion-dollar question. What do you do when you suddenly unlock over $100 million in cash? You don't just leave it in a checking account earning negligible interest.
Definitely not.
Management's answer to this question reveals an incredibly aggressive capital allocation strategy.
They are acting with absolute conviction regarding the underlying value of their company. They announced a massive expansion of their share repurchase program, targeting between $670 million and $700 million in stock buybacks for 2026.
Committing nearly $750 million simply to buy and retire your own shares is a huge move.
It is massive.
But the mechanics of how they are funding this buyback is what really caught my attention. They aren't just using their operating cash flow or that newly unlocked reserve cash. They actually went to the debt markets.
Yeah, they did.
They expanded an existing term loan by $200 million, bringing the total loan facility to $450 million. Let me stop right here, because borrowing money to buy stocks sounds inherently dangerous to most people.
Oh, for sure.
Is taking out a $200 million bank loan just to buy back your own equity a sign of brilliant, calculated confidence? Or is it reckless financial engineering?
It is a sophisticated maneuver based entirely on the cost of capital. To a retail investor, borrowing money to buy equities sounds like gambling on margin.
Right, like maxing out a credit card to buy crypto.
Exactly. But in corporate finance, if executed correctly, it is a highly accretive strategy. Management looks at their operational efficiency, they look at the incoming $130 million mortality windfall, and they look at their stock price, and they conclude that the public market is severely undervaluing their shares.
They believe the stock is dirt cheap compared to the actual cash the business generates.
Exactly. So they execute an arbitrage play, they go to the bank and secure a term loan at a fixed, relatively low interest rate. So let's hypothesize the cost of that debt is 6% annually.
Okay.
They take that borrowed cash and buy up their own stock. If they calculate that their stock is currently generating an earnings yield of 10 or 12%, they are effectively capturing the spread. They borrow at 6% to acquire an asset yielding 12%.
And by retiring those shares, they permanently shrink the float. If the company makes $285 million in net operating income, and they use this borrowed money to eliminate millions of shares from existence, that $285 million is now divided among a much smaller pool of remaining shares.
The earnings per share mechanically increases for every investor who simply holds onto their position.
Without the company needing to sell a single additional life insurance policy.
Exactly. Taking on manageable debt to force this mathematical outcome is the ultimate signal that the C-suite believes their equity is deeply undervalued. They are locking in fixed-rate capital, pushing the maturity date of that loan all the way out to 2029, and letting the financial engineering work its magic over the next 3 years.
They are essentially eating their own cooking. They see the underlying metrics, they know the actuarial tables are shifting in their favor, and they're leveraging the balance sheet to maximize the reward for current shareholders.
Which is exactly what you want to see.
Which brings us to the final verdict. We promised an actionable, opinionated conclusion based on the totality of this transcript.
And evaluating the core operational data, the demographic tailwinds, and the aggressive financial engineering, the thesis is straightforward.
We are definitively bullish on Globe Life.
Strongly bullish. The foundation of this company is a highly resilient cash-generating machine. Achieving an 18.4% return on equity in a legacy financial sector proves extreme operational discipline. The United American Division's 29% surge in health premiums demonstrates they are perfectly positioned to capture the massive, undeniable demographic wave of the silver tsunami.
And the actuarial math is also fundamentally working in their favor. The favorable mortality trends are acting as this built-in financial tailwind, unlocking over $100 million in trapped capital. And finally, management is executing a masterclass in capital allocation, using strategic debt to aggressively buy back undervalued shares and force the earnings per share higher.
However, no investment thesis is devoid of risk, and a prudent investor must always monitor the vulnerabilities. For Globe Life, the critical metric to watch in the coming quarters is their human infrastructure.
Specifically, the American Income Life, or AL, agent count. In the second quarter, the average producing agent count for AL was down 7% year over year.
That's the leak in the engine.
Right. As we discussed regarding the AI search disruption, this company survives by routing complex digital leads to live humans. You cannot sell life insurance efficiently without an army of agents closing the deals. A 7% contraction in that army is a noticeable leak.
Management did not shy away from this weakness, though. Matt Darden addressed it directly, outlining recent compensation restructuring designed to improve agent recruiting and retention.
Which is good.
More importantly, he made a forward-looking promise to Wall Street, stating they expect to see mid-single-digit growth in both agent count and life sales at American Income in the second half of the year.
And that is your actionable takeaway right there. If you hold this stock or plan to initiate a position, you must hold management accountable to that specific promise. When the Q3 earnings transcript drops, search for AL agent count.
Yep.
If that metric isn't growing in the mid-single digits as promised, you will know their human infrastructure is stalling, which directly jeopardizes their entire defense against the rising costs of digital marketing.
And that reliance on human agents to offset digital marketing costs, it raises a much broader question that extends far beyond Globe Life. It touches on a subtle yet seismic shift in the digital economy.
This is the provocative thought we want to leave you to mull over as you review your broader portfolio. We spent significant time unpacking how artificial intelligence is disrupting the fundamental mechanics of Google search, driving up the customer acquisition costs for direct-to-consumer pipelines.
Right.
Globe Life is navigating this because they have the physical infrastructure, the live agents, to convert those expensive leads at a high rate.
So consider the implications for the rest of the financial sector. If generative AI and large language models are making digital customer acquisition too complex and too expensive for a multi-billion-dollar giant like Globe Life, how will AI disrupt the customer acquisition pipelines for every other legacy financial, insurance, and banking company you are invested in?
It is a terrifying proposition for any business model that relies heavily on cheap, passive digital clicks to drive revenue.
Absolutely terrifying.
The era of optimizing a website for Google keywords and just watching the cheap leads roll in might be ending, replaced by AI intermediaries that act as highly expensive toll booths.
Well, you really need to evaluate your holdings and ask a very simple question. When the digital toll booth becomes prohibitively expensive, which companies in my portfolio have the physical infrastructure and the human talent to actually close a high-margin deal, and which companies are going to slowly starve for traffic?
The internet's basic plumbing is being rewired right now, and the companies that adapt their acquisition funnels will thrive, while those clinging to the old SEO playbook will drown. Keep your eyes on the shifting actuarial tables, watch those human agent counts, and as always, keep diving deep.
Thank you for listening.
We'll see you on the next deep dive.